welcome to my channel. I'm Doris. I'm here to share with you about market update today. Today, bank stocks rose across the board and the World Bank describes a lost decade. In my account today, because right now I have zero position of the market stocks right now, so the net asset of my account is still 73,406.29 cents. And looking at the market today, market closed mixed with Dow Jones Industrial Average closed with a gain of 0.6%, Nasdaq decreased for 0.47%, and S&P 500 rose for 0.16%. The internet content and other tech industries closed down, and on the other side, the insurance banks, regional banks, and just banks in general rose overall. At the same time, oil and gas also rose for more than 2%. U.S. stocks closed mixed on Monday, with banks generally higher. First Citizens' acquisition of all its deposits and loans that the U.S. authorities are now considering, helping First Republic strengthen balance sheet, boosted market sentiment. First Citizen Bank and the Federal Deposit Insurance Corporation are portal accept all deposits and loans from Silicon Valley Bank, with the deposit insurance fund spending about $20 billion after bankruptcy of the SVB. Meanwhile, reports that the U.S. authorities are considering expanding bank emergency lending programs could give First Republic more time to strengthen its liquidity. First Republic fell 46.3% last week, as investors worry whether several banks deposit $30 billion in the bank will be enough to support its balance sheet. U.S. regional bank stocks rose on Monday, with First Citizen Bank surging more than 50%. First Republic Bank up 12% and PacWest closed up 3.5%. Invesco global market strategist Brian Levitt said, sentiment is improving as policymakers take steps to ease the recent banking crisis. The delay of the Fed's liquidity facility has significantly eased previous concerns that a series of bank runs could be imminent. Still, some analysts say that whilst the Silicon Valley Bank deal had helped inject some confidence into the stability of the banking sector, fears of a bigger crisis had not completely abated. Hargreaves Lansdowne. Moving some of bankrupt banks to new owners could give regulators greater power to deal with problems that are still possible elsewhere, particularly for U.S. regional banks, says Susanna Streeter, head of money and market. But he noted, the biggest concern is that they have a large unrealized losses, not only their bond portfolio but also other assets hit by the storm of high interest rates. In addition, several big Wall Street banks warned that U.S. commercial real estate could be the next industry to explode after the banking crisis. Nearly $1 trillion in debt maturing over the next 2 years, and the possibility of a small banks tightening their loan exposure to follow big banks have added the pressure on commercial real estate. Outflows from smaller banks to industry giants such as J.P. Morgan Chase and Wells Fargo have slowed in recent days. Goldman Sachs analyst Jan Jesus said in a report on Monday, We still believe that Treasury has the ability to support unsecured deposits if necessary. While we will not completely rule out action from the Treasury if banking sector resumes pressure, the possibility of unilateral action by the Treasury seems very low. In their speech last week, Fed Chairman Colin Powell and Treasury Secretary Janet Yellen both assured investors that the U.S. banking system remains stable and received government support. World Bank describes the lost decade. The World Bank says a potential global economic growth has fallen to its weakest level in 30 years. On a high trajectory, a global economy began the new millennium, but its maximum speed limit, the highest long-term growth possible without triggering inflation, is expected to slow to 2.2% a year. Between 2022 and 2030, an agency said in a report released on Monday. The global economy lost decade may be formed. The World Bank chief economist, senior vice governor of development economics Intermit, Zhou said in a press release. The potential growth decline seriously affected the global response to our euro unique, expanding challenge ability of stubborn poverty, the widening income gap, and climate change. In 550-page report, the Multilateral Development Bank offered a silver lining, but potential growth could accelerate by up to 2.9% if policymakers deploy the right plans to increase productivity, increase labor supply, and strengthen investment. Analyst who wrote the report said things could get worse. If the global financial crisis or recession happens, the potential growth would fall even worse. To curb the decline in the potential growth rate, the authors wrote the following specific policy prescriptions. Labor buffer, changing demographic with a shrinking workforce and declining labor participation as many societies age. Explain about half of the potential slowing down in economic growth by 2030. In particular, the authors point to the economies with lagging female labor participation, saying that if some economies in South Asia, Middle East, and North Africa raise the rate of a par with emerging market and developing economies, their potential growth is expected to increase by 1.2 percentage points a year between 2022 and 2030. Fiscal monetary policy coordination. This has become a wake-up call in the post-pandemic era. The government and the central banks need to work together more closely to ensure that their policy objectives are not mutually divided, especially as inflation remains high. The World Bank report called for a focus on curbing inflation, strengthening the stability of the financial sector, and reducing debt to win back investor confidence. Investment boost. The report says governments need to invest more money on projects, especially to mitigate climate risks, including transportation, energy, agriculture, and land and water systems. The authors believe the move could provide a cushion of 0.3 percentage points a year against potential growth. Cut trade costs. World Bank analysts called for countries with the highest cost of transportation and logistics, while halving the cost of advancing trade liberalization and trade agreements, including improving customs and border procedures that actually increase tariffs. Another study cited by the report showed that the cost of transit delays is quite high, with daily shipping cost equivalent to a 0.8% tariff. Service engine. The report hailed services as a potential engine of economic growth, noting that exports of digital services related to ICT surged during the COVID-19 pandemic, accounting for half of all service exports in 2021, compared with just a 40% 2 years ago. This is a boon to higher productivity, the analyst writes, and that developing economies should particularly seek to strengthen relevant education and training. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.